I want you to think about something most people never calculate. Honestly, you wake up around 7 in the morning, you get ready, you spend time going to work, you work 8 hours, then you spend time getting home. By the time the day is finished, you may have spent 10 hours of your life working for money, 10 hours every working day. But what is your money doing during those same hours? For many people, the answer is painful. Nothing. It sits in a bank account earning almost nothing. It sits in a checking account waiting to be spent. It sits in a savings account earning less than inflation. The human being works all day. The money sleeps all day. That is a bad arrangement. And yet it is how many households operate. They work hard to earn money, then store the money in a place where it quietly loses purchasing power. They think they are being safe. But what they are often doing is allowing inflation to make their work worth less over time. That is the first principle. Safety is not only about avoiding market volatility, safety is also about protecting purchasing power. If your money does not grow at least as fast as the cost of life, then it is shrinking in real terms. The number in the account may stay the same, but the real value declines. That is why I do not think about investing as gambling. I think about it as making money participate in the productive system instead of leaving it asleep. The point is not to day trade. The point is not to chase hot stocks. The point is not to turn your life into a screen full of blinking charts. If your investments keep you awake at night, that is not financial planning. That is self-inflicted stress. A good allocation should be boring enough to let you live your life. It should be like setting a washing machine. You choose the cycle, you press start, then you leave the machine alone while it does its work. That is the spirit of passive investing. Not excitement, not prediction, not constant tinkering. A system. That is what most people lack. They may have money, they may have good intentions, they may watch financial videos, they may hear a friend mention a fund, they may buy one stock because someone sounded confident, but they do not have a system. And without a system, money tends to drift. It drifts into spending, it drifts into panic decisions, it drifts into whatever idea was loudest that week. A system stops that drift. The milestone I want to use is $10,000. Not because $10,000 makes you rich, it does not. Not because $10,000 guarantees financial freedom, it does not. But $10,000 is a powerful psychological threshold. It is large enough to feel real, small enough to be achievable, big enough to teach you what it feels like when money begins working for you. That feeling matters the first time money produces income without you working extra hours. Something changes in the mind. Maybe it is only $50 a month. Maybe it is only a small dividend. Maybe it is only a little growth in an account. But it is the first evidence that money can work while you are not working. That is a different relationship with money. Most people only know earned income. They trade time for dollars. Then the dollars disappear into bills. Asset income teaches a different lesson. An asset can work even when you are sleeping. That does not mean the asset always goes up. It does not mean there is no risk, but it means the money has a job. A $10,000 starting point can make that real. If $10,000 earns 6% in a year, that is $600, that is $50. Per month, $50 may not sound life-changing, but it arrives from ownership, not overtime. It arrives while you are watching a movie, sitting with family, or walking outside. That is the beginning of a psychological shift. You realize money can become a worker. And if $10,000 can produce $50 a month, then $100,000 can produce much more. Then $300,000 can produce more again. The first amount is not the destination, it is the first machine. Now, before building the system, we need to destroy 3 myths. The first myth is that investing is dangerous and saving is safe. This sounds logical because people can see market volatility. A stock chart falls, and the danger is obvious. A savings account does not visibly fall, so people think it is safe. But that is incomplete. If inflation is around 3.3% and a 1-year fixed deposit or ordinary savings product yields around 1.9%, then the money is losing purchasing power. The account balance may rise slightly, the real value falls. If that continues for years, the effect becomes serious. A $10,000 balance may still say $10,000, but what it can buy may fall toward $8,700 in 10 years after inflation pressure. That is not safety, that is a slow leak. It is like carrying water up a mountain in a bucket with a hole in the bottom. You can feel proud of the effort, you can work hard, you can save carefully, but if the bucket leaks faster than you notice, your real wealth declines. That is what inflation does to idle cash. Cash has a role. Cash protects emergencies. Cash gives flexibility. Cash prevents forced selling. But cash is not a complete long-term wealth strategy. It is a tool, not the whole machine. The second myth is that you need a lot of money to start investing. People tell themselves they will begin when they have $50,000, or 100,000, or when the market is safe, or when their income is higher, or when they understand everything. This delay is expensive. $10,000 is enough to begin building the system. Even $1,000 can begin the habit. The amount is not the first issue, the structure is. It is like going to the gym. You do not refuse to work out because the dumbbells are only 10 pounds. The goal at the beginning is not to lift the heaviest weight in the room. The goal is to learn the movement, build the habit, and avoid injury. Investing works the same way. The first portfolio is not only about return, it is about learning behavior. How do you react when the market falls? Can you keep buying? Can you avoid checking the account every hour? Can you rebalance? Can you hold a diversified plan? Can you stop chasing every new idea? $10,000 can teach those lessons. The third myth is that investing means staring at charts and doing endless research. If someone is a professional investor, perhaps that is part of the work, but most people have jobs, families, health, responsibilities, and lives. They do not need to turn investing into a second full-time job. In fact, for many people, trying to outsmart the market with constant research produces worse results. The market is a machine filled with professionals, institutions, algorithms, analysts, insiders, specialists, and people with more time and information. For an ordinary investor, the wiser path is often to admit the market is smarter than you are and join it rather than try to beat it. That is what broad ETFs and index funds allow you to do. You do not need to pick the one perfect stock. You own the system. You own thousands of companies. You let business productivity, dividends, earnings growth, and time work together. This is not glamorous. It is effective. And the best investment strategy for a busy person is often the one that requires the least emotional interference. Now, let us build the $10,000 system. It has 3 layers: the safety net, the growth engine, the opportunity bullets. The first layer is the safety net, 20%, $2,000. This money is not for investing. That sounds strange in a video about investing, but it is essential. The safety net belongs in a high-yield checking account, savings account, money market fund, savings plan, or short-term fixed deposit, depending on what is available and appropriate. The purpose is not maximum return. The purpose is psychological and practical stability. A pipe breaks, the car needs repairs, a medical bill appears, a job is lost, a family emergency happens. Life does not ask whether the stock market is up before sending you a bill. If all your money is invested and an emergency arrives during a market decline, you may be forced to sell at a loss. That is how many people fail at investing. Not because their long-term idea was wrong, because their liquidity was wrong. They were forced out of the position at the worst time. The safety net prevents that. It gives you the confidence to leave the growth engine alone. This is one of the most important ideas in portfolio construction. Cash does not only sit there, cash protects the rest of the portfolio. Liquidity is not wasted if it prevents forced selling. It is the oxygen that lets the system survive. A person who has no emergency fund cannot be a strong long-term investor because life has leverage over them. The second layer is the growth engine. 60%, $6,000. This is the core of the allocation. The job of this money is long-term steady growth. This is where broad stock ETFs and bond ETFs come in. The source system splits this core into 2 parts. 70% of the growth engine goes into broad stock market ETFs such as VT, VO, or VTI. 30% goes into bond ETFs or investment-grade corporate bonds. Let us translate that. From the $10,000, $6,000 is the growth engine. 70% of that $6,000 or $4,200 goes into broad stocks, 30% or $1,800 goes into bonds. Why combine stocks and bonds? Because they play different roles. Stocks represent growth. They are ownership in businesses. They can produce higher long-term returns because companies can grow earnings, raise prices, reinvest, innovate, and distribute profits. Over long periods, broad stock exposure has historically produced strong returns, often in the range of 8 to 10% annualized depending on the market period and measurement. But stocks are volatile, they fall, sometimes sharply. Bonds provide stability. Their returns are usually lower, often around 3 to 5% depending on the bond type and interest rate environment. But bonds can cushion the portfolio when stocks fall. They can reduce the emotional violence of the ride. They can provide income and stability. This does not mean bonds always rise when stocks fall. Markets are more complicated than that. But in a balanced system, bonds often reduce overall volatility and give the investor something less aggressive than a pure stock portfolio. That matters, because the best portfolio is not the one with the highest theoretical return. The best portfolio is the one a person can actually hold through bad periods. A 100% stock portfolio may produce stronger returns for someone who can hold it for decades, but many people cannot emotionally hold it. They panic, they sell, they turn temporary loss into permanent loss. A 70-30 structure is a way to pursue growth while reducing stomach, churning volatility. It is not magic, it is balance. Now, the source system does not invest the $6,000 all at once. It divides it across 6 months, $1,000 per month. This is dollar cost averaging. Dollar cost averaging matters because it removes the pressure of perfect timing. If you invest all $6,000 at once and the market drops the next week, you may feel regret. If you wait forever for the perfect low, you may never invest. Dollar cost averaging spreads your entry points. Some purchases may be high, some may be lower. The average cost becomes less dependent on one decision. This is psychologically powerful. The greatest enemy for many investors is not the market, it is the fear of making one wrong move. Dollar cost averaging reduces that fear. It turns investing into a process instead of a single dramatic decision. The third layer is opportunity bullets, 20%, $2,000. This is flexible cash for market dislocations. The safety net protects life. The opportunity bullets exploit market fear. Those are different jobs. The safety net is not touched for investing. The opportunity fund is kept ready for chances. The source document uses a simple rule. When the broad market drops more than 15% from its peak, begin deploying the opportunity bullets in batches. This is important. The rule is defined before the panic. If you wait until the market crashes to decide what to do, your emotions will be loud. Headlines will be frightening. Friends will say the system is breaking. Your mind will want to wait for clarity, but the best opportunities often appear before clarity returns. That is why a pre-written rule helps. If the market drops more than 15%, I begin deploying the opportunity fund in batches. Not all at once batches. This creates discipline. It lets you buy when others are scared without pretending you know the exact bottom. What if the market keeps going up and never drops 15%? Then the opportunity bullets may sit in a money market fund or short-term ETF earning perhaps 2 to 3% depending on the environment. This may underperform stocks in a bull market. That is the trade-off. Cash optionality has a cost, but when the market falls and everyone else is panic selling, that cash becomes psychological power. You are not forced to sell. You are prepared to buy. That is a very different emotional position. In 2022, when markets fell, someone with opportunity cash could buy assets at lower prices. When the market recovered in 2023, those purchases could produce strong gains. That does not mean every decline recovers quickly, but it shows the value of preparation. The person with a plan sees a crash as painful but usable. The person without a plan sees only fear. Now, if this sounds complicated, it is actually simple in execution. The complexity is mostly in thinking clearly before acting. Once the system is built, the steps are straightforward. Step 1 is to open a brokerage account. Today, this can often be done online with an ID, bank account details, and basic personal information. Many major brokers offer low-cost access to ETFs and zero-commission trading for many products. The important criteria are low fees, reliability, ease of use, and access to the funds or ETFs you intend to buy. Do not overcomplicate this step. A broker is a platform. The plan matters more than the platform. Step 2 is to set up automatic transfers. This is crucial because human nature is unreliable. If you require yourself to log in every month, think about the market. Decide whether you feel confident and then make the purchase. You create many opportunities to procrastinate. A better system pulls money automatically. When the paycheck arrives, a portion moves into the investment system. You do not negotiate with yourself each time. After a while, the money leaving becomes normal. It is like an automatic mortgage payment or utility bill. The habit becomes built into life. This is how systems beat emotion. Step 3 is to pick the ETFs or funds. For someone who does not know what to choose, the simplest starting point is a total market ETF or broad index fund, VTI, VU, VT. These are examples. VTI gives broad U.S. total market exposure. VU tracks the SP 500. VT gives global stock exposure. There is no perfect ETF. There is only what is suitable for your goal. Risk tolerance and belief about diversification. Do not spend months comparing tiny differences while inflation eats cash and the habit never begins. Action matters. A good simple fund held for decades is often better than an endlessly researched perfect fund never bought. Step 4 is to set a rebalancing schedule. Rebalancing means returning the portfolio to the intended allocation. Suppose the growth engine is designed to be 70% stocks and 30% bonds. After a strong stock market year, the mix may become 80% stocks and 20% bonds. That means the portfolio has become riskier than intended. Rebalancing would sell some stocks or direct new contributions toward bonds to bring the mix back towards 70-30. This feels counterintuitive. You are trimming what went up and adding to what lagged. But that is the essence. Rebalancing forces discipline. It helps you sell high and buy low in a structured way. The source system uses a 6-month rebalancing schedule that is not too frequent, but it is often enough to keep the portfolio near its target. It may take less than 30 minutes. But the effect is important. It prevents the portfolio from drifting into a risk profile you did not choose. Step 5 is to keep learning, but do not overreact. Investing is a lifelong process. You should understand markets, inflation, rates, and broad trends. But learning is not the same as constant trading. A person can spend 1 or 2 hours per month reading financial articles or watching thoughtful material to understand the macro environment. That does not mean changing the portfolio every week. Retail investors often underperform market indexes by 3 to 5% because of frequent trading and emotional decisions. They buy after prices rise, they sell after prices fall, they overreact to headlines. They chase what already worked. They abandon boring strategies too early. The best strategy for most people is often simple. Buy, hold, rebalance, repeat. That is not exciting, but wealth does not need excitement. It needs discipline. Now, what returns can someone expect? A 70-30 stock bond portfolio has historically produced long-term annualized returns around 6 to 8% depending on the period. Asset mix, inflation, fees, and taxes. Using 7% as an illustrative number. A $10,000 initial investment can become nearly $20,000 in 10 years. In 20 years, it can become over $38,000. In 30 years, it can become over $76,000. That is from the initial $10,000 alone. Now add ongoing contributions. If someone invests $200 per month on top of the original $10,000, the portfolio can grow to more than $300,000 over 30 years under that 7% assumption. That is the power of combining starting capital with recurring contributions. The $10,000 starts the machine, the monthly contributions keep feeding it, the return compounds both. Again, this is a projection, not a promise. Actual returns will vary, markets will fall, there will be bad years, there will be long stretches that test patience. But the projection shows the principle. A moderate return repeated for decades creates results that feel much larger than the original inputs. This is compound interest. It is not magic. It is time, returns, and reinvestment. The reason it feels magical is that the early years do not reveal the full power. The curve bends later. Most people quit before the bend. That is why a system matters. Now, let us talk about crashes. You will experience them. If you invest long enough, you will see markets fall, maybe 20%, maybe 30%, maybe more. It will feel terrible in March 2020. When the pandemic panic hit, many accounts dropped sharply. A person could look at the screen and see a 30% decline that hurts. The instinct is to sell. The news feels catastrophic. People say this time is different. But if the portfolio is built properly, the correct response may not be to sell. It may be to let the bonds cushion part of the decline, keep buying through automatic contributions, and use opportunity bullets. If the decline is large enough, that is why allocation matters. The system tells you what to do before fear takes over. Without a system, you become the market's emotional victim. With a system, a crash becomes part of the plan. This does not mean crashes are pleasant. They are not. It means they are survivable. And if you are still accumulating, they can become useful because you buy at lower prices. The biggest enemy in investing is often not the market. It is your own emotions. Fear makes you sell low. Greed makes you buy high. Boredom makes you abandon the plan. Envy makes you chase other people's trades. A system reduces the power of those emotions. The market will still be volatile, but you will not be forced to improvise. Now, there is another important lesson. Investment returns are not your only source of wealth. Your human capital may be your largest asset. If you are 30 years old earning $60,000 per year and you work until 65, that is $2.1 million of salary before raises. That is enormous. Your ability to earn income, improve skills, increase wages, build relationships, and expand opportunities may be more important than whether you squeeze 1% extra out of your portfolio this year. This is why it is dangerous to obsess over investments while ignoring career growth. A person can spend 3 hours per night comparing ETFs while doing nothing to improve income. That is not efficient. If your salary rises from $60,000 to $120,000, the amount you can invest each year can rise dramatically. That accelerates wealth much more than perfecting a tiny allocation detail. The source document gives an example of someone who started with $10,000 but also worked hard to improve professional skills. Over a few years, salary doubled from 60,000 to 120,000. Because income increased, the amount invested each year increased by age 38. The portfolio exceeded $100,000 and continued compounding. That is the correct way to think investing matters. But income fuels investing. Human capital feeds financial capital. The more your income grows while expenses remain controlled, the faster you can build assets. This is why the lazy portfolio does not mean lazy life. It means the investment system should be simple so your energy can go to higher value activities. Your career, your skills, your family, your health, your business, your network, your creativity. The portfolio works in the background. You work on the things only you can improve. That is the proper division of labor. Now, let us return to the $10,000 allocation and put it in one clean picture. $2,000 goes to the safety net. This protects life and prevents forced selling. $6,000 goes to the growth engine. Inside that, $4,200 goes to broad stock market ETFs, and $1,800 goes to bond ETFs or investment grade bonds. This engine is invested over 6 months at $1,000 per month to reduce timing stress. The final $2,000 becomes opportunity bullets. This cash waits in a money market fund or short-term vehicle and is deployed in batches when the broad market falls more than 15% from its peak. Then the system runs automatic transfers. Monthly investing 6-month rebalancing, occasional learning, no daily chart staring, no hot stock chasing, no emotional overtrading. That is the lazy way. Lazy does not mean careless. It means the system is designed, so you do not need to constantly intervene. A good system should reduce the need for heroic decisions. Heroic decisions are unreliable. Repeated small actions are more powerful. Now let us think about why most people do not do this. One reason is fear. They fear losing money. They fear choosing wrong. They fear starting at the wrong time. They fear being judged. They fear not knowing enough. Fear creates delay, but delay is also a decision. If you do nothing and leave money idle, inflation does not wait for your confidence. The purchasing power keeps eroding. Another reason is perfectionism. People want the best ETF, best broker, best month, best market condition, best return, best plan. Perfectionism looks responsible. Often it is procrastination wearing a suit. You do not need the perfect plan to begin. You need a reasonable plan that can be improved. A broad ETF, a bond allocation, a cash reserve, automatic transfers, rebalancing, that is enough to start. The third reason is lack of patience. People want results quickly. A 70-30 portfolio will not make someone rich overnight. It is not designed to. It is designed to build wealth over 10, 20, or 30 years. That long time horizon makes people impatient, but long horizons are where compounding works. The fourth reason is emotional reaction to market noise. The investor sees a recession headline, they pause, they see a stock market high, they wait, they see a crash, they panic, they see a rebound, they chase. This is why the system must be stronger than mood. Now, I want to talk about the phrase, make money work for you. People use it so often that it can sound like a slogan. But the idea is profound. A dollar can be consumed, a dollar can be saved, a dollar can be invested, a consumed dollar is gone, a saved dollar waits, an invested dollar goes into a productive system. That system may be a company, a government bond, a diversified fund, a property, a business. When money is invested wisely, it has the potential to produce income or growth. That is money working. When you spend all income, you remain the only worker. When your money works too, you begin building a second source of effort. At first, the second worker is weak, then it grows. Eventually, it can produce meaningful results. The goal is not to escape work immediately. The goal is to stop making labor the only engine that is financial freedom in its early form: choice, optionality, security, less dependence. Now let us consider the emotional effect of the first passive income, the first dividend, the first interest payment, the first month the account rises more than the amount you contributed. It changes perspective. Before that moment, money feels like something you chase. After that moment, money begins to feel like something you can deploy. That psychological shift is more valuable than the first small payment itself. It changes behavior. You begin asking, how can I buy more assets? How can I increase the machine? How can I reduce waste? How can I make my future self stronger? That is the identity shift. The person becomes an asset builder. This is why $10,000 is a milestone. It is not the end. It is the moment the machine becomes visible. Now let us think about the lazy approach from a risk standpoint. A lazy portfolio is not a no-risk portfolio. Stocks can fall, bonds can fall, especially when rates rise. A 70-30 portfolio can lose money. A global crisis can hurt all assets. Inflation can reduce real returns. Taxes can reduce returns. Fees can reduce returns. Behavior can destroy returns. So the word lazy must not be misunderstood. Lazy means low maintenance, not risk. Free, you still need to understand what you own. You still need an emergency fund. You still need a time horizon. You still need discipline. You still need to avoid high interest debt. The system is simple, but the responsibility is real. Now, how does the opportunity bullet strategy fit with passive investing? At first, it may look contradictory. Passive investing says buy and hold. Opportunity bullets say buy dips, but they can work together. The core portfolio is passive. It continues through automatic investing. The opportunity fund is a disciplined rule-based addition during large declines. It does not require predicting daily movement. It uses a predetermined threshold, such as a 15% broad market drop. The key is not to let opportunity bullets become gambling bullets. They are not for chasing meme stocks. They are not for panic trades. They are for adding to the same long-term assets when prices are significantly lower. That keeps the strategy coherent. A dip buying rule should strengthen the long-term plan, not turn it into speculation. Now, what about rebalancing during market drops? This can be powerful. If stocks fall and bonds hold up better, the portfolio may become underweight stocks. Rebalancing can move some money from bonds into stocks when stocks are cheaper. Again, this feels uncomfortable. You are buying what just fell. But that is the point. A disciplined system forces the behavior that emotions resist. If you wait until you feel good, the price may already be higher. Systems buy when rules say to buy. Emotions buy when comfort returns. Comfort usually returns late. Now, let us discuss time. 10 years, 20 years, 30 years. Most people think in weeks and months. Financial freedom is usually built in decades. If $10,000 grows to about $20,000 in 10 years at 7%, that is meaningful but not dramatic. At 20 years, it becomes more noticeable. At 30 years, the curve becomes much more powerful. Then add $200 per month, and the result becomes over $300,000 under the illustrative assumption. This is the lesson. The initial $10,000 matters. But continued contributions matter just as much. A portfolio without ongoing contributions grows. A portfolio with ongoing contributions compounds more strongly. A portfolio with rising contributions as income grows compounds even faster. That is where human capital returns to the story. Increase income, keep spending controlled. Increase contributions, let the asset allocation work. That is the real machine. Now, suppose someone does not have $10,000 yet. Start smaller. The structure can be scaled if you have $1,000, perhaps $200 for safety, $600 for growth, $200 for opportunity. If you have $5,000, scale it. If you have $100 per month, start there. The system is more important than the exact starting amount. Do not let the $10,000 milestone become an excuse to delay. It is a useful framework, not a gate you must wait behind forever. If you can begin with less, begin, then build toward 10,000, then beyond. Now, suppose someone has much more than $10,000, the same logic can apply, but more customization may be needed. Larger portfolios need more tax planning, more attention to account types, more risk management, maybe more asset classes, maybe international exposure, maybe specific bond duration management, maybe estate planning, maybe insurance planning, but the core principles remain: safety net, growth engine, opportunity, cash, automation, rebalancing, discipline. The size changes, the principles stay. Now, what mistakes should people avoid? The first mistake is leaving all $10,000 idle in the bank because of fear. Cash is necessary. Too much idle cash for too long loses purchasing power. The second mistake is investing the entire $10,000 at once without any emergency cash. That creates fragility. The third mistake is chasing individual stocks or hot funds without a plan. That replaces system with impulse. The fourth mistake is trying to time the perfect entry. That usually leads to delay. The fifth mistake is checking the account constantly. That increases emotional interference. The sixth mistake is stopping contributions during market declines. That often turns volatility from opportunity into regret. The seventh mistake is ignoring income growth. The portfolio matters, but your career and skills may create the largest source of investable capital. The eighth mistake is failing to rebalance. A portfolio that drifts can become too risky or too conservative. The ninth mistake is misunderstanding returns as guaranteed. Projections are models, not promises. The 10th mistake is giving up because the early results are small. The early years are supposed to look small. That is how compounding begins. Now let us close the system. Your money can sleep or it can work. If it sleeps in cash while inflation rises, the account may look safe but lose power. If it works in a diversified allocation, it will face volatility but can build long-term wealth. The right answer is not all cash or all risk. It is structure 20% safety net, 60% growth engine, 20% opportunity bullets. Automatic transfers, dollar cost averaging, broad ETFs, bonds for stability, rebalancing every 6 months. Learning without overreacting, career growth alongside investment growth. That is a calm system. Not perfect, not guaranteed, but coherent, and coherence matters because most people lose not from one bad market day, but from having no process. They panic, they procrastinate, they chase, they stop, they restart, they never let compounding finish its work. A lazy allocation is powerful because it removes the need to constantly decide. It lets you focus on the rest of life, family, health, career, skills, rest. The portfolio does not need your constant attention to do its job. It needs your capital, your discipline, and your patience. That is the truth. The best time to invest may have been 10 years ago, but the second best time is not a slogan. It is a decision. It is the moment you stop waiting to feel perfectly ready and start building the system. $10,000 may not be life-changing on its own, but $10,000 placed into a sound system can become the beginning of a different relationship with money. You stop only working for money. You begin making money work for you. And when that happens, stress begins to shrink, confidence begins to grow, and you start gaining something more valuable than return choice. That is the real meaning of financial management. Not getting rich overnight, building the freedom to make better choices later because you made disciplined choices today.